Most people will tell you that incomes have not been keeping up with inflation. I mean, that's kind of obvious now. But there's one big piece of this puzzle that a lot of people are completely ignoring. Take a look. This is a chart from the Federal Reserve Bank showing wage growth in America, and what you can see is the wage growth peaked in mid-2022 at around 6.7%, and it's been falling steadily ever since. But now let's compare this wage growth with inflation levels. The red line here shows CPI inflation levels, and what you'll see is that back in June of 2022, inflation peaked at 9.1%, and then it fell quite a bit, but now it's been kind of steady and actually rising over the last few months. Now, I don't know if you caught that little bit in the end, but I'm going to show you the two charts on the same screen. That way you can understand better of what's going on right now. So if you look at the inflation chart, you'll see that inflation peaked at 9.1%, while wage growth only peaked at 6.7%. But if you go back to the inflation chart, you'll see that inflation is rising now, versus wage growth is falling now. See, this is where understanding the trends are very important, because we understand the past. We know that in the past, inflation outpaced wages, which is why a lot of people are struggling to buy things today, because inflation grew faster than wages. But if we look at what's going on now, what we're seeing happen today is that wages are falling while inflation has been rising. And that's not a very good trend to have happen at the same time, because that means things are getting more expensive while wages are not keeping up even faster, or in some instances, wages are actually falling. Or to just put it more bluntly, it looks like a lot of Americans are going to be seeing a pay cut relative to inflation in 2024. In fact, according to Indeed, the job posting site's labor economist, the pace of wage deceleration is striking. Posted wage growth has fallen by almost 3 percentage points in just the past year. But it's not all bad news, because some people, the financially educated, have been seeing a windfall. Investment prices have been skyrocketing over the same period. Like if we take a look at the S&P 500 over the last 12 months, it grew by around 25%. And if we look at over the last 5 years, the S&P 500 is up nearly 75%. Now this is where you tend to get a lot of generic and just kind of pointless advice, which is that investing your money is important. And I think by now, most people, not everybody, but most people understand the importance of investing, but it kind of just ends there. And a lot of people are left wondering, well, what do I invest in? And how do I invest my money? And how do I actually benefit from the way that this financial system works? Which is where I want to take this a step further and help you actually understand how you can win in this system, because the reality is those who are financially educated have been winning, and they will continue to win. Now, does this mean that asset prices are only going to go up? No, of course not. I mean, investment prices go up and down. We've seen booms and busts happen in our economy. That's the way that our economic system works. But those who are financially educated know how to win when markets are up, and they know how to win when markets are down as well. That way you can continue building wealth, because unfortunately in this system, things are not going to get better. I mean, if we look at what's going to be coming in 2025, 2026, 2027, and 2028, it's probably not going to be better than what it is today. In fact, things are going to continue getting more expensive, and more Americans are going to continue to struggle. And this is where either you're going to have to make the sacrifice today to start putting in the work to be more financially educated so you can win, or you can start 3 or 4 years from now when it's even more difficult. And I'll leave that option up to you, but this is where, again, it's very important to be financially educated. And I want to go over now, what does it actually mean to invest your money, and how do you actually take advantage of things in this economic system? And of course, I do want to let you know that investing has risks. You're never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So when it comes to investing now, the first thing you got to understand is what kind of strategy do you want? And there are two general strategies when it comes to investing. I call them an active strategy, and I call it a passive strategy. Now, the first thing I want to make sure is absolutely 100% clear. When I talk about investing money, I am not talking about trading stocks. I'm not talking about flipping real estate. I'm not talking about trying to find the next hot stock. I'm talking about investing money, which means at the very least, owning something for a year, if not many years, if not decades, because that's where the real wealth is built. I am not a trader. I tried trading for a little while when I was in college, and I realized that was a very difficult and not a very good way for me to make money. So I don't talk about trading. I don't know how to make money with trading. Everything that I talk about has to do with investing, because I only like to talk about things that I know and understand. So now, when we talk about investing, there are two general ways that I like to talk about investing: an active strategy and a passive strategy. And what a passive strategy means on a general level is it is more hands-off, where you create a system and you set it and forget it. I'll talk about more of what that means in just a second. The second strategy is more of an active strategy, which is where you're looking more for an individual investment. This might be a real estate property to go out and buy yourself. This might be an individual company like Amazon or Tesla or McDonald's, and looking for the right stock for you to go out and buy. That's what active investing is. Now, what ends up happening to a lot of people is most people assume that you have to be an active investor, that you have to find the next hot stock, that you have to go out and find a real estate piece to go out and purchase. But the reality is most Americans, 98% of Americans should not be active investors because either they don't have the time to do that, or they don't have the interest to do that, or they don't have the psychology to manage their investments. Because you have to know what to buy, you have to know when to buy it, you have to know how long to hold on to it, you have to know how to sell it. And all these things can be difficult when you're going through a crazy economy. I mean, if you look at any news site, you'll see how crazy the headlines can be. And these crazy headlines drive a lot of emotions. And humans are emotional beings. And it's very easy to be driven by these emotions. But if you're driven by these emotions, it is very easy to lose money, which is why a lot of people lose money when they go and they try to be an investor, because they try to find the next hot stock. They try to go out and invest in real estate with no money down without knowing what they're doing. And then they end up losing their money and giving this property or asset to somebody else at a very much discounted price, which is why I say that 98% of people should be a passive investor, but you don't have to pick one or the other. This is just one thing that you want to understand of knowing what is your strategy. I personally do both. I have a passive strategy and I have an active strategy. I'm going to talk about both of these, but you have to find what is right for you, because what's right for you might not be right for me. And you have a different risk tolerance than me, you have a different interest level than me, and you have different financial goals than me. So let's go a little bit deeper. What is the next question that you have to ask as you start to come up with your investment strategy? And I do want to let you know that one of the things that can help you as an investor is paying attention to what's happening in the financial news. And that's why I created Market Briefs as a free financial newsletter to keep you up to date on what is happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, the next question you want to ask, once you get an idea of if you want to be a passive investor, an active investor, or a hybrid of both, is how do you want to get paid? Because there are two general ways that you can get paid. You can get paid through cash flow, I'll call that CF, or you can get paid through appreciation, I'll call that APP. Now, cash flow is exactly what the name says. You own an asset and you're getting paid with cash flow. If you go out and buy a stock and it pays you with a dividend every 3 months, that's cash flow because you're getting paid without having to sell your investment. If you go and buy a rental property and you're getting paid every month from the rental income, after paying for your expenses, you have a profit, that's cash flow. I like cash flow. The bulk of my investments are for cash flow because I love the idea of getting paid without having to sell my investments, versus most traditional financial planning, most traditional advisors will push people into this appreciation. Now, neither one of these are right or wrong. They both can be great. You have to find the right option for you. Appreciation is, I'm going to go out and invest my money into the stock market. I'm going to put $100 into it, and hopefully this will be worth $200, $500, $1,000, $10,000 at some point in the future. That's what appreciation is. Now, what you have to figure out is what's right for you. And the way that you decide that is understanding the pros and cons of both, because there are pros and cons of cash flow. The pro of cash flow is you could cash in your pocket today, so you lower some of that risk. And the pro is, well, now you can use that money to either buy more investments or you can use that money to fund your lifestyle. But the con of cash flow is when I get paid my dividends, when I get paid my cash flow from my rental properties, even if I reinvest all this money, I have to pay taxes on that income. And that can be a con for some people. Now, when it comes to appreciation, the same thing is there. The pro is, well, you don't have to worry about those taxes because a company can reinvest those profits as opposed to giving it out, and you don't have to worry about paying taxes. I mean, if you make a huge profit in a stock value, you choose how you want to pay taxes, because if you don't sell, you don't pay taxes. So you kind of have more control there. But the con is you also have a little bit more risk because, well, all of your money and profits are tied up into this asset value, and we all know that asset values can fluctuate. Real estate prices go up and down. Stock prices go up and down. And you might think that you have a huge profit one day, but if the stock market crashes the next day, well, you could lose a huge chunk of that appreciation if you need to sell during a time when markets are down. So you got to find what's right for you. I can only talk about what's right for me. And for me, the bulk of my investments are for cash flow because I love cash flow. My goal is to fund my lifestyle from my cash flow. That way I can spend all the cash flow and get another cash flow check next month. So my game is stacking cash flow. buy assets that pay cash flow, use the cash flow to buy more cash flow, and just keep stacking that cash flow until I have enough cash flow to fund my entire lifestyle. Now, the next question you want to ask once you understand this is, what is it that you want to invest in? Now, there are a lot of investment options out there. You can invest in stocks, you can invest in real estate, you can invest in your own business, you can invest in paying down debt, you can invest in cryptocurrency, you can invest in startups, you can invest in wine, you can invest in gold, you can invest in a whole bunch of things. And the thing that I want you to understand is, as you're getting started on your investment journey, the first thing that I want you to do is be extremely focused on the things that have been proven and time-tested. And that means use the bulk of your investment money. Use at least 90% of your investment money on proven assets. And 10% or less, ideally less, especially in the beginning until you've built your wealth. Use 10% or less of your money to invest in more speculative assets. So what does that mean? The things that are proven are, number one, paying down debts that aren't making you any money. So if you have debts on your car, if you have credit card debt, well, if you have credit card debt, you should not be worried about any of this. Pay down a credit card debt before you do anything else. But if you have credit card debt, if you have other types of loans, these are things that you can pay off and get a guaranteed return on. If you have student loans that are costing you 6, 7, or 8% a year and you paid off a year early, you got a guaranteed 6, 7, or 8% return on your money. So that is a guaranteed way to invest. Then the other options here that are proven are, number one, stocks, and number two, real estate. I'm not going to talk about your own business because yes, that is a proven way, but I'm going to talk about more other assets, not your own. If you have a business idea, that is a great option. I'm 100% pro entrepreneurs because, well, that's what worked for me as well. But let's talk about that in a different video because I'm going to focus more on the financial side of things of investing in other assets. So the two proven asset classes outside of business that have built more wealth than anything else over the last century are stocks and real estate. And these have been time-tested and proven. So after you think about the debt, stocks and real estate should be the very bulk of your portfolio. The other 10% can be more of the speculative assets, things like investing in startups, things like investing in cryptocurrencies. Gold is a little bit interesting because I invest in gold, but for me, I don't consider gold an investment. I look at gold as a way for me to save hard money. I don't look at it as an investment. I don't really care about what's happening with the prices of gold. I've been buying gold for a pretty long time now, but I just buy a little bit of gold every single month and I don't think about it. It's just sitting there. It's not an investment because it's not producing any value. The gold is just sitting there doing nothing. It's just sitting in a vault. So for me, it's a way to save hard money as opposed to an investment for me. About 2% of my total investment portfolio is physical gold, and then the bulk of my investments, outside of my speculative ones, are for cash flow purposes. So now, as we go down this list, as you decide, okay, I want to be more of an active or a passive investor, now you decide if you want more cash flow or appreciation, now you can look into stocks or real estate. And now, when we look into stocks and real estate, the question is now, how do you actually go about doing this? Because now, if you want to be an active investor in stocks, well, now you have to go out and find individual companies. Now you're looking for what you believe is an undervalued company that has a lot of potential in the future, that is going to be innovating, and that is going to be worth a whole lot more money. Or maybe it's going to pay out cash flow depending on what your goal is. Now, in order to do this, there's a lot of analysis involved. This is called fundamental analysis, where you look at the financial statements. You look at things like the cash flow statement, the income statement, and the balance sheet. And now you start to analyze the numbers. You start digging into the company. You look into what the executives are. You look at what moat this company has, which means what is the competitive advantage that other companies don't have. And you start looking into, is this a good company that you want to invest in? Not just a good stock, but a good company because you are investing in a company. But when it comes to the passive investing, that's a little bit different. Now, I'm not here to tell you what to invest in. I'm just giving you some examples. But the way that passive investing works is you want to set up a system where every week, or every 2 weeks, or every month, every so often, money is going to automatically leave a checkings account and it's going to be passively invested into a portfolio of funds. What are these funds? It can be ETFs, it can be index funds, it can be mutual funds. All a fund is a basket of stocks. Now, I'm not going to go into the differences of all three in this video. I have other videos on my channel where I go over that. But what you have to understand is now when you're investing in this basket of stocks, the whole idea here is you want to limit your risk. Because if you're going to just passively have this system where money is automatically invested every week, for example, you want to make sure you're investing your money into an asset that's not going bankrupt. Because, well, if you invest your money into a company for years and years and years, and then you find out that Sears is going bankrupt, which was the company you were investing in, well, now you're in trouble. Your life savings are gone. And this is where if you invest in a basket of companies, now you can protect some of that risk. Yeah, you might get a little bit lower returns, but you're also limiting the risk because the goal of a passive investor is set it and forget it. And I'm going to go over a few examples of different ETFs. I personally like ETFs, but you can decide if you like ETFs, index funds, or mutual funds. So for example, again, not telling you what to invest in, hypotheticals, VTI is an ETF that gives you exposure to the total stock market. So when you hear the stock market is rising, VTI is going up. When you hear the stock market is falling, VTI is going down. When you buy one share of this ETF, you're buying exposure to the total stock market. But if you want to get a little bit more specific, then you have the S&P 500 funds. The S&P 500 is a group of the 500 largest companies by market capitalization in the stock market. Now, instead of you going out and buying a piece of all 500 companies, you can invest in a fund like SPY or VOO to get exposure to the S&P 500. And as a disclaimer, I personally own shares of VOO. So now, if you buy shares of either one of these ETFs, you're buying a piece of the S&P 500, you're buying a piece of the 500 largest companies in the stock market. But maybe you want to invest in the Dow Jones. The Dow Jones is one of the most well-known and regarded baskets of companies in the stock market. Well, if you want to invest in the Dow Jones, you can do that by investing in an ETF called DIA. Maybe you want to invest in the NASDAQ. The NASDAQ today is much more tech heavy, and if you wanted to invest in the NASDAQ, well, you can use a fund for that. You can invest in a fund like QQQ to give you exposure to the NASDAQ, or if you're saying, but Jaspreet, I want to invest for cash flow. I like what you said about dividends. Well, there are funds that give you exposure to dividends. There's a bunch of them out there, but one example is a fund that will give you exposure to dividend-paying companies inside of the S&P 500. So you have this S&P 500, a group of 500 large companies. Out of those 500 large companies, some of them, not all of them, will pay a dividend. If you just wanted to invest in those dividend-paying companies, there are funds like SPYD that will give you exposure to those dividend-paying companies. Now, the way that you succeed with this strategy is by following a CPA, consistent, passive, and automated system. You want to keep consistently investing your money. I have a system where every Wednesday, money is pulled out of my checking account and is automatically invested into my portfolio of ETFs. This happens when the market is up, and it happens when the market is down. It doesn't matter what's going on in the world. It doesn't matter what's going on in the markets. It doesn't matter if markets are crashing. I keep investing. In fact, if markets are crashing, that's a good time for me to come in and buy even more aggressively. But this is where the key is. You want to be consistent. Consistent means you keep investing no matter what's happening, no matter what sales Macy is happening, no matter what's happening in the markets, you keep investing because you want to keep building up your shares in these funds. You want to keep building up your shares in the markets. You want to keep building up your shares in these companies. That way you can continue to build wealth. And you got to understand that there will be hardship. That's a part of our economic system. There will be times where the market goes down. We have seen a recession in this country pretty much every decade for the last century, and it will happen again, which means markets will crash again. We saw stock market crash in 2020. We saw stock market crash in 2008 along with the real estate crash. We saw stock market crash in 2000. We will see more stock market crashes in the future, and what I want you to do is understand the next time it happens that you don't panic, that you don't freak out, that you don't sell your investments, and that you don't say, oh my God, the stock market is broken. It's part of our system. Markets go up and markets go down, but the way that you win is about being consistent when markets are up and down, because if you take a look at the stock market over the last century, we've seen that the market has gone up despite all the crashes, despite all the recessions, despite all the craziness. And if you believe in the future of America, then the stock market is a way for you to own a piece of the companies that make America America. If you believe that America is going to collapse, then you probably don't want to invest in stocks, especially American stocks. But that's just really what you got to understand. Now, the second thing is, well, what if you want to go out and invest in real estate? Just like with real estate, if you wanted to invest in an active strategy, well, now you're going to go out and look for the individual property. Again, that's much more complex. Where now you're going to find a good property, whether it's a single family home, whether it's an apartment complex, whether it is a other type of mixed use building. You're going to go out and try to find the best building. You're going to run the numbers. You're going to get the capital to go out and buy it. You're going to buy the property, stabilize it, renovate it, give it to a property manager, and now if you do it correctly, your cash flow from your rents should pay for the expenses, should pay for whatever fees that you have, and then put some money in your pocket. That's the correct way to invest in real estate. I love investing in real estate because you can get this type of cash flow when you do it correctly and get tax breaks. But a lot of people don't like that idea. But they want to get exposure to real estate. They say, I want to invest in real estate, I just don't want to be a landlord. I want to invest in real estate, I just don't want to have to deal with tenants. Which, you know what, that's fine. And if you don't want to have to deal with the headache of dealing with a property manager, of having to manage your properties, that's okay. You don't have to. I don't manage any of my properties. I have a property manager, but even if you don't want to do that, that's okay. The alternative is you can invest in funds that give you exposure to real estate. Now, there's a lot of ways to find these funds. If you go to any real estate investor conference in your area, I can guarantee you that there's going to be some investor, some developer, some real estate professional there that's looking for money. Because in real estate, well, it's expensive, and investors are always looking for money for the next deal. So this is a more difficult way, but you're gonna have to network with people. You have to find the right person, find the right deal, and then you can invest money into this person, into this fund, into this deal, and then you get exposure to this project, but you don't actually own the project, and you're not gonna have to go there and manage the deal. You're giving them money to help fund the deal, and maybe you'll get some equity in the deal, or maybe you'll get exposure to the deal. Maybe you'll get exposure to a fund that gives you exposure to the deal. Now, if you don't wanna have to go out and do that, there's a bunch of websites on the internet that allow you to do this. There are websites on the internet that allow for this type of crowdfunded real estate investing, where now you don't have to go out and worry about what is the right property. You just invest your money into this fund, and this fund is gonna give you exposure to a portfolio of real estate, and then you'll get your share of appreciation, if any, and you get your share of cash flow, if there is any. Now, of course, again, investing is risky. You're never guaranteed to make money because markets can go up and down. But the key to really making money is, number one, don't invest money that you aren't willing to lose. Because when you invest your money, you kind of want to think this money as gone, because you're going to go through a learning process. There will be times where markets go up and down, and you don't want to have this urgency or need to pull money out of the investments. And number two is you need to have a long-term investment mindset. If all you're thinking about is the next 6 months or the next 12 months, it's going to be impossible for you to succeed, because all you're doing is watching the day-to-day move of your investments. You want to just let your investments do their thing, and that takes time. Because it takes time to use that money and compound and grow, and that's where you need time on your side. But you have to be patient, but also be willing to do the research, to use the financial education to invest your money the right way. Now, there's a lot of ways to get this financial education. Obviously, I have a ton of free content on YouTube. You can check out what we have at Briefs Media, briefs.co. We have a lot of financial education there as well. But the key here is you are investing in your financial education, and you're working to continually keep investing. And when you see opportunities, meaning if you see a market crash, if you see asset prices fall, you use that as an opportunity to go in and buy even more aggressively, because it allows you to buy those investments at a discounted price. I mean, recessions have built more millionaires than any other time, because they allow investors to buy assets, to buy investments for pennies on the dollar. Commercial foreclosures sank during the pandemic, but over the last 12 months, we've been seeing this steady rise in commercial real estate foreclosures. A foreclosure doesn't just mean that a landlord is running out of money. It also means that a bank isn't getting paid. Banks are having to write off these bad loans, putting more stress on the banking sector at a time where the banking sector was already struggling.